Let me start by raising the question, does anyone have questions? Any questions on the first part of the problem? By the way, I did, thank you, last and June, thank you for my entertainment during our break. There's a regulation 168D-1B3, two little i's. It essentially says that if you put property into service and you sell it the same year, no depreciation, okay? So,
Are you going to do that to us when we have?
no. Why not know? Why not know? Right? Okay, so everyone, we have accelerated, we have straight line, we have accelerated. Agreed? And everyone, right, is going to apply the half-year convention. Right? And
Why is that again? Did you say that?
what the
half-year convention?
well, generally, when you put property into service, you use the
Oh, that's
half-year
right.
convention, unless the mid-quarter convention applies, right? Or unless it's real property, and then the mid-month convention, or unless it's intangible, and then the full month convention applies. All right. So 1C, we have year, we have percent, we have amount. We have the adjusted basis. Okay, and then question C, it says, C is B except depreciate or dispose of the equipment on December 1st of year 5. So suppose we dispose of the equipment December 5th of year 5. Okay. How much depreciation would we have in year 5? We dispose of the equipment in year 5, guys. Give me a dollar amount. How much would the depreciation be in year 5, guys? 17,280 in year 5. It would not be 34,560 because we disposed of it, right? We get half the depreciation. This is what a full year, but we're in the half-year convention, right, Nick? When we sell it, so we would get a half year's worth of depreciation. Everyone ready? Katie, you got this?
Yeah, I guess.
What's the guess part, though?
No, I just didn't know if you were going to write anything down. But
I don't need to. I mean, the answer to 1C is taking this number divided by 2.
Yeah.
That's it. Right, John?
Yes.
Right? Everyone got this. Again, whatever convention you use when you acquire property is the same convention you must use, right, Ji-Ying, when you dispose of it, right? It's mechanical. It's not because I want it to be this way, the code instructs it to be this way. Question 1D. Assume the same facts as B, except depreciator also elects to use 179. What additional facts do you need to know? Let's start with the second question first. What additional facts do you need to know? What is the additional fact to here?
Is it new? Yes.
Well, yes, is it new? But what question are the authors really driving at?
New or used?
Have you put more than $2 million of property into service, right? Right? Because if you have, you're going to lose the 179 deduction. Now, this book was obviously crafted prior to the $500,000 exemption being made permanent. So, give me a dollar figure. Let's put for this problem 1D. Let's suppose the taxpayer put into service for problem 1D property worth $800,000. $800,000. If they put property into worth $800,000, what would be the first year's depreciation? Say again?
500.
No, it's not just 500. We start off with code section 179 of 500,000, which reduces the basis to 300,000. Right? Everyone agree?
Yeah.
But then, in addition, we get our normal depreciation, right? Well, what's the depreciation on 300,000 under the normal rules, guys?
Even with the first year?
30,000?
No, it's not 30,000. It's 20%, right? Right? We would just go through the computation here. Everyone agree?
So no convention?
Well, when you say that, it is the convention. It's 20%. Normal is 40%. Right? And then, guys, we're off to the races, and we would just do our normal depreciation. You would just pick up where we left off. So obviously, I just use this for convenience. Show the first year, select 179. You not only get the regular depreciation, excuse me, you not only get the 179 depreciation, you get the regular depreciation, right?
So the 300,000 case, you would depreciate it?
You would depreciate then the full $300,000 K. And it would be under this depreciation schedule.
There's no limitations on this equipment?
What do you mean by limitation?
Limitation.
There's no limitation.
It's 20 years.
It's not listed property. Okay, no limitations. Question D. Or to E. The equipment has a 6-year class life. The depreciator elects to use the alternate depreciation system. Okay? Now, I do not know too many taxpayers who elect the alternate depreciation system. In fact, I know none. But you will see, sometimes for purposes of computing earnings and profits, under Code Section 312 in the corporate realm, you're forced to use the alternative depreciation system. Alternative depreciation, what's the recovery period? If you look at Code Section 168G, the recovery period is the class life. You must use the class life as the recovery period. And you must use straight line depreciation. So, in this case, Jessica, if that's the case, you're mine. How many years are we going to depreciate this over? 7, right? Because we have to go 1, 2, 3, 4, 5, 6, 7. Because our class life is 6 years, and then using the half-year convention, we're going to end up with 7 years. How much is the first year's depreciation? What percent? Under straight line, it's usually what? 1/7, but here it's not going to be 1/7, right? It's going to be 1. Say again, Anna?
I mean, I thought 1/6.
No, 1/6.
Are we using 168?
Okay, I'm sorry, it's 6-year class life. It's usually 1/6, but because of the half-year convention, it'd be 1/12, right? What percent is 1/12, guys, on your calculator?
0.83, 10, 10.
It's 8 1/3%. Right, 1/12. Normally it's 1/6, but because they have year convention, it's 1/12. How much depreciation is that? $25,000. The adjusted basis here would be $275, right? Year 2. It'd be normally 1/6. What's 1/6 equal to? 16 2/3. Or 50,000. This would be 225,000. And we would just go 1, 6, 1, 6, 1, 6, 1, 6. And the last year would be 112. And this would all be 16 2/3, except for the last year would be 8 1/3. This would all be $50,000 down until the last year, when it'd be 25,000. And then we have 175, 125, 75, 25, and then 0. All right, this is just another illustration of straight line depreciation, right, guys? Just another illustration of straight line depreciation. Question 2. On January 2nd of the current year, for $1 million, depreciator purchases new equipment for use in her business. The purchase is made from an unrelated person. By the way, the authors have just, the reason they mention unrelated person is because if it was made from a related person, there's a chance that the anti-churning rules would apply, but even in the year 2016 and going forward, the chances of the anti-churning rules applying, truth be told, are virtually nil. So I'm not going to worry about it. The equipment has a 6-year class life and is 5-year property. Sound familiar? Assume the 168 pay amount is 50%. How much depreciation is, depreciator's cost may be written off in the current year. She has $2 million in taxable income for the year. I'd like to use 179 and makes no other elections under 168. So the authors just want us to run through this and figure out the first year's depreciation on this property. Year 1, how much depreciation can the taxpayer take? I'll try to keep my mouth shut for a minute. Come up with a number of what's the total depreciation allowable. Alicia, Andy, Stephanie, Justin, you have numbers? No? Anyone have a number? Down in the front row, Strawn?
I think I have a number, but it's just similar to the previous week.
So what's the total depreciation for year 1?
300,000.
300. Annetta?
I have a lower number, but.
Lower number. Alicia?
600.
600. Busto? Say again? 240. Evelina? 300. Diana?
I'm revising my number.
Alicia says what number? 550. And Anna?
I thought 150.
150. Matt?
Oh, not 150, 550, I'm sorry.
550. Matt?
I was going much higher.
Go for it.
Isn't it, do you apply 179 and 168 to this one?
You do?
So let me take half first. No, I mean, sorry, 500,000 first.
Okay, so that reduces the basis to what?
So half a million.
Yeah,
And then you take 50% of that, which is 250. And then,
and keep going.
and then normal depreciation.
Yeah, which would give us what?
We're doing straight line. I didn't see that.
No, well, who said straight line? Taking normal makers. So what is first year depreciation on 250?
50. 50, and then doubles. Well, it'll be 50. Using half.
It would be 50,000, right? Because it's 20%, it's normally 40%, but because they have year convention, it's not 40%, it's 20% of 250 would be 50,000. So at the end of the year, bingo, guys, $800,000 of depreciation allowed the first year. No wonder why our government's bankrupt. We're letting the taxpayers write off $800,000 of $1 million purchase. So now I think the matching concept is being lost on Congress. What's the issue, Ashley?
So, the regular double declining, why do you times that by 250?
This is the adjusted basis, right?
So, okay, so the adjusted basis goes from 1 million
Well, it got reduced.
to, okay.
The 500 down to 250, and then we just apply normal depreciation. All right? We good?
I think I'm confused with the 1D, how.
Just say it loudly. You're confused by what?
With the example where section 179,
Right?
the 500,000 is greater than the adjusted basis.
What do you mean it's greater than the adjusted basis?
In 1D over there. Isn't 500 greater than 300?
I know, but we said that we made this property worth 800,000. In problem 1D, we said only to make this problem worthwhile, we're gonna assume the fair market value to be 800,000. That's an important thing to have in your notes, so you're not confused in a week from now or 2 weeks from now. All right, so everyone see the authors in this problem are trying to illustrate just what happens the first year. Very robust depreciation. Question B. What happens if depreciator does not use 179? So come up with a number. If depreciator does not elect 179, but uses 168K in normal depreciation. Johnny, you got a number?
600.
How much?
600.
600. Zach, you agree?
I didn't get an answer yet, sorry.
Yeah, you didn't get it yet? Elise? Not sure? Louis?
600.
600. Johnny, how did you get that?
50% bonus. 500.
So 168K, you took 500,000, right? And then under normal depreciation, what did you do?
The 20%.
So you got your
The
head?
20%.
20%, which gives you 100, total is 600, right? Agreed. Okay. Question C. What results in B if depreciator also elects out of 168K? So we're just on our normal depreciation. You guys know the answer to this one, right? So how much depreciation will we have? 100,000, right? Question D. A resultant depreciator also elects to use straight line depreciation. Okay? Straight line depreciation in question D. How much depreciation will we have? 100,000. Right, Alicia? Why? It's normally 1/5, but because they have here convention, be 1/10 of a million, be 100,000. Everyone got that? Ready to move on? High roller buys luxury automobile for business and personal use at a cost of $25,000. That's such a luxury automobile, right? Assume for simplicity that the allowable amount of depreciation is $10,560 if there is no inflation after 1987. Okay. Compute the maximum depreciation allowance is available at a high, assuming no 179 election is made and there is no personal use of the car. So, what the authors are trying to draw your attention to, if you could, open up to code section 280, capital letter F. Everyone have 280, capital letter F? This gives you the limitations for what is deductible when it comes to quote-unquote luxury automobiles. So notwithstanding double declining, this is 5-year class property. Car is 5-year class property. Is you can take the lesser of these amounts or the allowable depreciation. So if you bought, suppose you bought a smart car, which is not so smart. But what's the allowed, and you bought it for $10,000. How much depreciation could you take under makers for a smart car? It costs $10,000, guys. What's the first year? John? 2,000, right? It goes under the normal depreciation, double declining, it's 20% the first year, right? So if you buy a cheap car, that's going to cap you, right, at normal depreciation. Agreed? Congress does permit, though, and again, rhetorically I'll ask why, because it, not for smarter minds than mine to answer. When it comes to cars, everyone's got the mid-quarter convention. Well, I'll just spell it out up here. Is that year one, and then amount of depreciation is with cars because they're listed property 4, 5, 6, 7, 8, 9. You'll see that the first year, Congress is giving a little bit of bonus depreciation even for cars. You can deduct, as the authors point out, $10,560. But then, it doesn't matter what the accelerated method would permit, because usually it's 40% of what remains, but you're capped at $4,100. So that this becomes the cap, even though there's still $15,000 of depreciation. Last I checked, 15,000 times 40% of it's 6, but this still caps at 4,100. The next year, you're capped at 24,050. And where am I getting these numbers from? Straight from Code Section 280F, capital letter A. This is the amount of depreciation that we're allowed. And until we get to the final year, we get to depreciate the entire car. But again, there's this cap that Code Section 280F. Nick, you had questions?
Did you just get 5 on purpose?
No, I just skipped it because I'm invoking the after 8 o'clock rule. By the way, I made a mistake. Someone said last week in the New York Times, there was an article that the Trump Towers are misnumbered purposefully so that they project a higher number of floors than actually exist. So this was my paying homage to the Trump Towers, okay? I skipped a number. All right, everyone got this?
Why does, can you explain the first year again?
The first year time was in this code section that the authors pointed out. It's code section 168 K2, capital letter E, one little I. I'll repeat, 168 K2 E, one little I. Congress permits this extra accelerated depreciation the first year, even as to listed property.
And that comes 280F.
Yes. Now, the authors point out what happens if the person uses the car for business and personal reasons. What you do is you take the numbers that we just computed and you just multiply them by 0.7, 0.8, 0.7, and then you would go down, it would be 0.6 all the way down. And you would get reduced depreciation deductions, right? Just like the airplane. So if you only have a car for business use and personal use, you deduct only that percentage which is used for business. By the way, can I just tell you, you ever have an issue that gnaws at you, but you never had time to like resolve it, right? You have one of those issues that you're like, it's annoying, but you just don't have the time to get around. And before the age of Google, you really didn't find the time. Now you're like really angry at yourself. You can't even take 2 seconds to Google it. But let me just tell you, again, my life is a very shallow one perhaps, is that here's my gnawing issue. Is I would look at this, okay, and for several years I just didn't have the time, and I'm thinking to myself, okay, so let's keep it real clean here, and let's just suppose the person, just hear me on this one, uses the car at 80% for business and 20% for personal, right? So they're going to be able to deduct 80% of 25,000 or 20,000. Everyone agree? And they're going to not be able to deduct 5,000, right? And every year, get the visual, they're deducting 80%, right? Of whatever the depreciation. But keep in mind, they're not deducting 20%. So, like, I was concerned, like, if you keep playing this out, like, what do they call it, the Monty, that you keep playing it out, like, they're going to start deducting 80% of whatever the basis remains. So at some point, they're going to start deducting their personal use because they just keep deducting the 80%. Okay? Until they get to 0. It was like, that doesn't make sense though. They shouldn't be allowed to. All right, so one day, like what happens to all of us, like, I'm tired of having this issue annoying. So if you look at code section 280 capital letter F, D2, I'm just going to call to your attention that even though you use something, code section capital 280F, section D2, is that you have to reduce your basis, okay? Even for the personal use. In other words, even though you only get to deduct, in my example, 80% of the allowable depreciation, you have to deduct 100% of the whole depreciation for taxation purposes. Otherwise, again, we would never get to zero. So I'm just sharing this with you, is that Congress does think of these loose ends and puts those things that, at least in some instances, those things that don't like to be put to bed. All right, so I don't want to belabor this, guys. The answer here, again, if you take a percentage, not surprising. Question 3C, we're not going to have time for. It deals with issues that once it goes to 50% or less, you have to use the alternate depreciation system. In question 3C, you're not going to see this on the exam. And you actually have to recapture. Part of your prior benefits. But again, that's an issue for a different day. Question 4. Vic purchased a restaurant from owner and has made the following payments as part of the purchase in storing the restaurant. Determine the deductibility of Vic's payments. A payment is made to owner for goodwill. Luca.
No deduction.
Why no deduction?
Just against me.
Okay. Is it an intangible asset?
Yeah.
Okay, what's your authority for it being an intangible asset? Where would we at least begin, Matt? Where would we begin to look? Mike, what code section? 197, right? Is this an asset that we can amortize? Is it an amortizable asset? I heard yes. What's our authority? Goodwill. Look at code section 197C1. Which is acquired by the taxpayer after the date of enactment and held in connection with the trade or business. And code section 197 D1A. D1A includes, guess what? Goodwill. So can this be amortized, the cost of goodwill over 15 years, guys? Absolutely. How about question 4B? Payment to owner for a covenant not to compete lasting for a 5-year period. Payment to owner for a covenant not to compete. What do you think? Where would you love to see if it's a 197 asset? And 197D. And what does D1E say? Any covenant not to compete. Can you amortize it over 5 years because that's when the covenant not to compete lasts over?
No.
No, right? Alicia, how many years?
15.
15. Everyone got that? How about a payment to the media to advertise the restaurant? You have to amortize advertising expenses, guys?
Not yet.
Not yet. No, that's never going to happen, or at least not under the new administration for sure. Okay? Deductible immediately, right? Advertising expenses under 162 are generally deductible. How about payment to owner? To buy owner's restaurant franchise. Well, we know it's capitalized, but can you amortize it?
Yes.
Which, if you say yes, what's your authority?
It's 197 DF.
Subsection 197D1F.
D1.
D1F. All right, everyone see that? These are all acquisitions that can be amortized, right? Or must be amortized over 2 years. Do not worry about question 4E because it gets more complicated than I want, okay? Not going to worry about it. Question 5. Law student incurred $3,000 in expenses to take bar review course and $500 for admission fees. Discuss the deductibility of expenses. How about the $3,000 in the bar review course? That's an education expense, right? Alicia, what do you say?
I know CPA review course wasn't deductible.
The CPA review course isn't deductible, nor should a bar review, right? It qualifies you for a new trade or business under 162-5, should not be deductible, right? Not deductible. How about the bar admissions dues? Probably, here, I'll give you the practical answer, and then I'll give you the real answer. Most people, they're going to deduct this, I suspect. But, if you look at Section 197 D1D says that you should amortize it over 15 years. So, for exam purposes, 15 years. You guys ready to depreciate some real estate? Whatever, shake your head no. Come on. Busto's ready. He's got that monster. All right, let's talk about depreciation rules for real estate, guys. For your purposes, again, very mechanical. There's two numbers. Well, there's a few, but two in particular you got to keep in mind. And if it's rental property, residential rental, 27.5 is the useful life. If it's any other kind, commercial real estate, it's 39 years. It's 27.5 and 39 years. Those are the two biggies. We know, universally, you must use the mid-month convention. So, what this means is, let's suppose you put property into service in November. What will be your numerator and denominator if you put it in November? What's your numerator and denominator? We're putting in real estate into service in November. It's November. We put it in service today. What's your numerator and denominator for the convention purposes?
11 over 12.
Say again?
11 over 12.
Would that be right, Louis?
Wait, what convention?
It's real property.
1.5.
Say again, to here?
1.5.
Yeah, it's mid-month convention, right, Johanny? So it'd be 1.5 over 12, right? We sell it next November, right? We sell it next November, a year from today. Lou, what would our convention be here? We sell it in November.
10.5 over 12.
10.5 over 12, right? Because we've held it for most of the year. Okay? Remember, when you sell property in a different year, remember to rethink your conventions, right? The month of November no longer means 1.5 over 12, it means 10.5 over 12, right? A lot of students, I apologize, but again, I want you guys to make my vacation. They forget to do that. They say, oh, and they think, suppose in December, if the property is acquired in December, they think, oh, 0.5 over 12. Oh, they sell it in December, 0.5 over 12. No. I say, no, 11.5 over 12. Again, my vacation is in your hand. Do not forget to flip. Everyone remember that? Must flip. The authors in our textbook point out that Congress sometimes will give certain credits. What kind of credits they give? Hey, they want to preserve historical structures or fairly old structures, so sometimes they'll give pretty nice credits, but the credits will offset tax due, dollar for dollar, nice. But remember, credits also will reduce your tax basis, and I'll show you in a few minutes some examples of this. All right. Do not, for exam purposes, worry about the low-income housing credits. We could spend 8 to 10 hours, have a full-day seminar on the low-income housing credits. People have developed a lifetime worth of work around low-income housing credits. Okay, so it's not something that we want to venture down. On page 467, there's a problem. Depreciator purchases a piece of new improved real property at a cost of $130,000, of which $100,000 is attributable to a building, and $30,000 to the land. Okay? Depreciator immediately rents out the property to others. Suppose the building is an apartment complex. What I would ask is compute the depreciation in year 1 and year 2. And let's just say it's put into service in October. Okay, you buy the apartment building in October. What is the depreciation in year 1? What is the depreciation in year 2? Come up with a quick number. Okay, quick number. Stephanie, you got it? Alicia, you got the number? Not yet?
What's the last one?
We bought it in October, I said. Betty, you got the number? Ashley?
I just got the October back.
Are you whispering?
No, not yet.
Tina? Serena?
Not yet.
454, Alicia?
I have
77.
757.
757. Annetta? 20,000 something. Let's just go through year 1. Tell me, Alicia, what did you multiply?
Well, first of all, I divided by 27 and a half, so I know
So it's 100,000 times 1/27.5, right? Times what?
2.5 over 12.
2.5 over 12 equals how much?
757.
757? Okay, $757. I didn't do the math, but that's the right numbers, unless someone comes up with a different. All we did is, and what's the depreciation for year 2?
Without the, I mean, instead
It's
of
100,000 times
1/27.5.
1/27.5, which is equal to how much? 3636. All right, everyone agree? Brian, you got that?
What is this 2.5 divided?
This is the convention, mid-month convention. We put it into service in October. So we have October, November, December. It's 2
How was
point.
it determined, the convention?
I'm sorry, Alicia?
How was the convention determined?
It's always mid-month for real estate.
Oh, for real?
Always mid-month.
And it's all straight line?
Always straight line.
Yeah.
Really boring, right? I asked this on the exam, you're going to say, well, it's asking too easy of a question. Right, Nick?
Wasn't 100,000 then for the second one? Wouldn't it be less, whatever? What is
No, it's not double declining, it's straight line.
Oh,
Year 2 is.
thank you.
How about the building is an office building and we bought it in January, okay? Come up with a number. You buy an office building in January. Come up with a number.
For the first year?
First year and the second year. Come up with 2 numbers. First year and second year. So Luke, you got a number?
For the first year,
Yeah.
534.
534 is that.
I got 2457.
Okay, so there's a difference to here.
I got 2457.
All right, so to here, how did you get it?
$100,000 divided by 39.
Times 1 times 39, that's,
11.5 over 12.
yeah, comes out to be, how much?
2457.
2457. And the next year, we would just take 100,000 times,
139.
times 1 over, right, Busto, 1 over 39 equals how much?
It's 2564.
2564. Wes, you got that? Jackie, you got that?
Yeah, why is it 11.5?
Because it was bought in January, mid-month convention. It's 11.5, 10.5, 9.5, all the way down to December where it's 0.5 over 12. All right, just say Busto, say it loudly.
Mid-quarter conventions are completely different.
Mid-quarter convention does not apply to real property. Which one's more accurate? Mid-quarter, half-year, or mid-quarter, let me start. Mid-month, mid-quarter, or half-year, which is the most accurate? Mid-month, right? So Congress isn't worried about taxpayers playing games here. Congress is more concerned about people gaining the half-year convention. What other questions? Keisha?
So, we're given the 4 options that we have for mid-quarter, correct?
When you say we're giving, you have 4
Like
choices.
we're given
You have four
10.5.
choices for the numerator.
Yeah, we're given that.
And with the mid-month, you have 12 choices. With the half year, someone's going to give you the finger. Sorry.
So, So with the mid-month, right? I think this is the part where I'm kind of missing. If it's February, we're gonna use 2.5.
That's if you sell it in February. If you buy it in February, there's still a lot of the year left.
Oh, so we'll use,
Tell us.
um,
That's the numerator in the Keisha if you buy it in February. It's a long year, remember.
10.
Yeah, say it, 10.5, thank you. 10.5 over 12. All right?
Why is 10.5 over 12?
Well, this, in January it's 11.5, and each year, each month you're going to dip one more month.
You don't depreciate.
Think about it, Nikisha. We don't have. We'll keep going here. Ashley, you had a question?
No, I'm just scratching my head.
You scratching your head? Okay, that's okay. All right, question C. Do not worry about. Okay, we don't care about depreciator's sister in the anti-trading rules. Question D. Suppose we use the alternate depreciation system. Okay. What is the class life of real estate under the alternate depreciation system? Look at, if you look at 168G2, 168G2, capital letter C. What is the recovery period for non-residential and residential real property? 40 years. Everyone see that? Code section 168G2, capital letter C, right? Everyone see 40 years? So in that case, if I put property into service, okay? I put it in September. We're back to September. We put property into service in September. Figure out the depreciation. Keisha, this has your name on it. I put property into service in September. I use the alternate depreciation system. Keisha, just tell me, the property itself is $100,000. What am I going to multiply it by? I have two other numbers. Just have to fill in 2 blanks, and you are in the promised land of the correct answer.
All right, hold on.
You don't need to multiply that. I just want to know what
All
to fill
right,
in.
so it's a building, so we're gonna do 39, 1 over 39.
That wouldn't be right, though. Diana, what number should we be using? 1 over 40, because they're using the alternate depreciation where it says to use 40 years.
Okay, all right, let's try for the other end. Let's see
Yeah, door number 2. Okay?
Okay, so the second one is in September, correct?
Yes.
Okay, so if it's in September.
Don't say it out loud.
Hold on.
It's like the audience members of the game show.
I'm gonna say, 3.5.
Would that be right, Edward? Nick? Yes, 3.5 over 12.
Right.
All right, Nikisha, there we go.
That's okay, I don't get it as much as you don't get it.
And the next year, how much depreciation will we take next year? Plus though? Say again, plus though? 2,500, right? Bingo. Question E. Some years later, $100,000 is spent to rehabilitate a building in A and B above, and they're certified historical structures. Certified. They're not just old, they're certified old. Okay? And I will draw your attention. Look, the authors are just trying to illustrate a point. Under Code Section 47A2, I never get into this, but I'll just share it with you. Under Code Section 47A2, for policy reasons, Congress wants people to rehabilitate certified historical structures. They offer 20% credit for $20,000. If you spend $100,000, they give you a credit of $20,000 on that $100,000. What's my authority? Code Section 47A2. And then under code section 50C1, under code section 50C1, you have to reduce your basis in the property from 100 to 80,000. Okay, if you get such a robust credit, you got to reduce your basis downward. Question F, 1F, says, suppose it's just an old building. It's not a building that's certified, but it was built in 1930, okay? So it's not certified, but it's a building built in 1930, which is before 1936, which is an arbitrary cutoff date. So if the building is built before 1930 and 1936, and you rehabilitate it, you can get a 10%, not 20% credit. What's my authority? Code section 47A1, and under code section 50C1, once again, your basis in that property for depreciation purposes would be reduced to $90,000. All right, so the authors, this is not what I really care about for the moment, guys, is problem A, B, and D, right? That's my, can you depreciate real property, okay? Making sure you understand the mid-month convention, right, Nikisha?
Yes.
And what is the periods? Now, before you close your books, give me 2 minutes to just help you with chapter 19. Next class, we're gonna blow through chapter 15, but also read the first 15 pages in chapter 19. But let me just explain how chapter 19 is divided, okay? Because this will help you, I hope. Chapter 19, guys, is divided into 4 parts, okay? 4 parts. We are going to be looking at the cash and accrual methods of accounting for timing purpose. Cash and accrual. And the chapter is divided into issues pertaining to inclusion and deduction. Inclusion and deduction. So the first half of chapter 19 deals with the cash method taxpayers. When must they include income? When will they be permitted deductions? And conversely, the second half of the chapter deals same issues, but from the perspective of the accrual method. What is the taxpayer's agenda with respect to inclusion issues? Generally, not always. Generally, the taxpayer wants to defer inclusion, right? Push it off. What is the IRS's agenda? Usually, not always, is to force it earlier, right? With respect to deductions, when do taxpayers want deductions? Now or later? Now. When does the IRS, generally, not always, say you're entitled to deductions? Later. So they have competing agendas, right? And those competing agendas often lead to court battles, all right? So for next class, not only are we going to cover chapter 15, but because chapter 19 is fairly long, because we only have 2 more classes, just bear in mind that I have every expectation to begin, not finish, chapter 19 for next class, okay? So I will see everyone next week.